it there. Well, to the extent that I've actually clicked record, it won't include any recordings that Matthew made. He used a different app, so it's only the recordings that I've made so far, which I think is only three, maybe. This is our third one, I believe, or fourth. Either way, whichever ones I've recorded, which I'm gonna do going forward. I encourage you guys to take a look at it and download it from your end. I'm not sure how long it keeps the file. I'm guessing it's actually, I shouldn't even make a guess, but I'm not sure how long it's going to keep the file there. So if you need to look at it, access the file, download it, make notes. I encourage you to do that, as soon as possible. So today what we're going to do, we're not going to do too much new stuff. Actually, we're not going to do any new stuff today at all. We're going to focus on preparing you for the midterm. So today is the day you need to ask me any questions that you still have regarding the material before the midterm. Again, this is your last opportunity to ask me any questions. If there's a couple items that you still don't unsure of, there's no such thing as a stupid question. Just make sure you ask the questions now. Please do not ask me over the weekend. Hey, can you explain this again? Can you explain that again? Or on Monday. Today's your opportunity to ask any questions that you have regarding the material that we've covered. Again, we're not meeting Monday. Monday is going to be the day dedicated for you to take the midterm. The midterm is time. You're going to have 3 hours to complete the midterm, but it will be open the full day, so you can actually take it at midnight. You can take it at in the afternoon, or the latest you can take it would be 5 p.m. in order for you to actually finish it by or 5:30. So in order for you to finish it by 8:30. Again, as long as it's completed by 8:30, then it'll be fine. And again, it has to be within that 3 hour period. And any questions on the midterm? No questions on the midterm? All right. So this is what we're gonna do.
And how
So
many questions are there on the midterm?
uh, one question. I'm kidding. Two questions. Actually, no. So there's going to be, and I already gave you an idea of the format. It's short answer questions. There's going to be one big problem at the end. That's going to be your problem where you have to figure out the tax computation, filing status, gross income, all that. That's going to be weighed in at 40 points. That's going to carry the most amount of weights. And then the other 60% is going to be split into six questions. So each question would be worth 10 points. So I guess you can say in total questions, seven questions. Again, six short answer questions worth 10 points each. And then the big problem, which is worth 40 points in total. So make sure you completely answer each one. Um, now, in terms of again, you'll have 3 hours to complete it, so you have more than enough time. But one thing I will say about the exam is there's going to be a couple questions, depending on your knowledge, that it may not take as long as the others. So use your time effectively, and efficiently. Do not spend a lot of time to, answer. Let's say I'm asking you a question, which I will ask you a question about the judicial system, and you hit all the points, the trial courts, you hit the appellate courts, regional, and the federal court and Supreme Court. That's it. You don't have to get into too much detail. And if I'm not asking you about the audit process, then don't give me the audit process. Try to just address the questions that I'm asking. If I ask you a question about, what are the differences between primary sources and secondary sources, again, in your own words, tell me the difference. And then you will also have to tell me, list each category: primary source and secondary source, and so forth. Again, primary has three categories. So as long as you're able to, answer the questions, you're fine. For some people, the actual computations may be easier. Some people it takes more time because they involve computations. Again, use your time efficiently and effectively. You will have 3 hours. All right, who just joined us? Somebody just. Okay. All right. Thanks. Anybody else joined us? So that was just you, Matthew. All right. Okay.
I have one more question. What do you consider, how short is a short answer? How many sentences or
Well, I mean,
how detailed do you want it to be?
use your
Because we
judgment
can
with
go
that.
on for pages.
Again, consider this. You know, you have 3 hours to complete the exam, and considering, and as I was just alluding to previously, enough to answer the questions. So again, if I'm asking about the judicial system, talk about the judicial system. Do not talk about the IRS system, the legislative process, if that's not part of the question. Again, make sure you address the points. Again, use your judgment. I guess that's the best way I can put it. But keep in mind that even with the short answer questions, try not to spend too much time on those, because there's going to be questions that involve problems, like big problem. So that's something to think about as well. The big problem, that's going to involve more work. Again, the short answer questions. Again, the only thing I could say, use your judgment on that one, to the extent that you answered all the bullet points. And I'll actually sort of talk about this today as we're going over the quiz, and that's fair question. But I'll talk about it as far as the quiz. As far as the computational questions, I think those are more straightforward. I think the bulk of your time should be in actually getting the computation correctly. There's going to be a question on the vacation home. As long as you're able to do the ratios, and we're going to do it in a few minutes, and as long as you're able to explain, you're only itemizing the first category, interest and taxes, and not the category 2 or category 3. And as long as you're able to explain that, and as long as you're able to explain the carryover portion, that's it. Again, you don't really have to get into too much detail. This gets reported on Schedule E. These are deductions for AGI. Again, if that's not a part of the question, don't try not to spend too much time on it. However, if you do finish early, and you just want to add more substance to your answer, again, it's use your judgment on that. Feel free to go over your answer. um, Again, I guess just look at it this way: you just do each question, move forward with each question, and then if you still have time, then just polish up some of your answers, and maybe you thought of something new to add. But at the same time, do not try not to spend too much time on one question. That's what I don't want you to do. Again, every student is different. Like some students will get the short answer questions, well, and some won't. Some students will do the computation questions, and some won't. It's all to your strength. That's the best that I can answer. But let me do the quiz, and that way you can have an idea. So the quiz that you're seeing right now. Uh, and this is the view that you'll be seeing, but it's actually not in the right bright space. This is just what I use to play with. It's my sandbox. But you guys know where to find it, right? You go to assessments, quizzes. That's going to have the list of your quizzes, same as you saw your first quiz. It's going to be listed as a quiz, but it's an actual exam. I'm going to click on exam. And remember, I said you can actually use Excel. So I'm going to let you use Excel. So I would encourage you to open up Excel or Word, probably Excel, because that would contain the equations. If you're going to have use Excel as a tool to help you with the answers, that's fine. Just make sure you create your own spreadsheet. Do not use one of my spreadsheets. Use one of your own. Okay, let's get started with the first question. You guys ready? Yes. All right, let's get started. Um, Wait, that's not supposed to happen. Let me do it the other way. I think I had the restrictions. Again, go to assessments. You'll see quizzes. Or you can actually click on it on the home screen. It should be listed there. Okay, start. Find what? The practice. Didn't I email that to you? Didn't I send that in a document?
The practice quiz?
I
Yes, you
think
Yeah.
it
did the
did
second
come via
one.
email.
I did send it in an email.
Yeah.
I think that's what I was thinking. Yeah, it wasn't on Brightspace, but I sent it through the email. Um, yeah, I'm not sure what to say about that. Oh, you guys see the question? Yeah, we'll do this question last because this one is the only one that involves computation. Again, your question is going to be very similar. Your big question is going to be similar to this, except there's going to be more facts, of course. Your question is going to be, very detailed facts. It's going to have information about dependence, information about filing status. I think the filing status is simple. It's more on who's an actual dependent and which credit is qualifying. That's pretty much it. Gross income exclusion. I think, I mean, I'm very confident that most everybody understands, what's excluded, and then just basic deductions and itemized deduction and the difference between the two. And then I'm going to give you this table. You see this table on the bottom? I'm going to give you that table for you to figure out what's the tax liability. That's why I included it here. So you are going to need something like this. Again, I'll encourage you to use scratch paper. You don't have to just do it on Excel, but I encourage you to use scratch paper if that helps. But let's do the ones, with, pretty, questions, basic questions. So question number 2, provide the dependency test for a qualifying child and the dependency test for qualifying relative. Again, I am not going to ask you this question in this format. This is just a review for you to understand the actual test. Again, I'll give you facts, and you have to be able to determine if it's a dependent or not based on the facts given, and if it's not a dependent, which test has not been met. So, but I'm going to ask you to write complete sentences. So I'm going to say what am I going to say? Dependency tests for qualifying child are what? Anybody? I forgot. Somebody?
Relationship.
Relate
Age.
relationship. So let's talk about age. So age, which is under 19 or under what?
24 and full-time student.
A full-time student. Okay, very good. Self-support, right? And what's one? Home, right? Pretty straightforward. And then the dependency test for qualifying relative are, what is it? I'm just going to list a gross income, and you already know how to apply it. It has to be less than the 4,200 or whatever the exemption is for that year. It's gross income test, support test, the taxpayer provides support, and relationship, or what's the other part? Part of the relationship, or member of household for whole year. It's pretty straightforward, right? Again, writing complete sentences. As you're going over the question, you see on top how it automatically saved it. You see it? It's going to do that, when as soon as you finish typing, it's going to automatically save it. So just, keep that in mind. It's, pretty straightforward. Um, Now this one, which trial courts require payment of tax prior to filing a petition? So the so what is it? I forgot. What is it? The
U.S. District Court and Court of
U.S.
Federal Claims.
U.S. District Court and U.S. Court of Federal Claims, right, are the two courts that require payment of tax first. Yeah, I'll just leave it at that. Well, you guys get the gist of it, right? No, that's how you're going to type in. You see how it's saving automatically? Um, Mia, was that you that just said something?
Yes.
Okay, when did you walk in?
Right after you said something about Matt, and then I was into.
Okay. You're supposed to tell me when you're here. I'll pick on you later.
Okay.
Actually, I know you know the answer for this one. Since you're on the topic, which federal trial court required petition within 90 days of the U.S. Of the statutory notice of deficiency? I know you know this one.
U.S. Tax Court.
Yeah, the U.S. I accidentally hit underline. U.S. Tax Court requires petitioning within 90 days of statutory notice of deficiency. Now, one thing I would say, I guess it does help if you're type fast. I'm not the quickest, typist, but I have a basic set of skills. So if you have good typing skills, that would help you, especially if you're typing. Um, and and any questions with this one? Pretty straightforward, right? Oh, trial court. Here's where we, talked a little bit about this before. So here's the regional circuit court of appeals. Who wants to tell me the answer to this one? Here's cases from which two trial courts? Somebody knew. I'll start it out. U.S. Circuit Court of Appeals, regional. I can't spell. Regional. Here's cases from anybody. Hannah, what do you think?
U.S. Tax Court and U.S. District Court.
U.S. Tax Court and U.S. District Court. Now, it's one thing about just basic sentence structure. I'm not going to grade you. This is not an English class, but of course it has to, make sense. So use basic sentence structure. Spelling, I'm not going to take any points off if you spelled words incorrectly or forgot to put a period. But again, as long as it's makes sense. But please do not give me a long run-on sentence that goes on and on and on and on. At least use periods. That's the best I can tell you with that. Oh, one thing about spelling. I don't know. Yeah, you can do spell check here, right? Can't you? Yeah, can you? Yeah, you can check spelling. So check spelling anyways. So there you have it. So I actually added this tool where it allows you to use other features, including Excel, and it also has a spelling feature. I'm assuming that's going to pick up basic grammatical errors, including punctuation and any other errors. But again, I'm sure everybody's going to do well on that part. All right, this is going to be a good question. Question 6 is probably a question that I'll probably ask you most likely. You can pretty much bet on it. So well, my question is going to be more like, describe the differences between the two, or what's the significance between the two, and explain and discuss, primary source in more detail. Provide an example of each category, something to that effect. So I'll say something like primary source of tax law, what carries weight.
Wait,
Something to that effect. And a tax audit or federal tax case, something like that. The following is it two spaces or one space after each sentence? Didn't they change that? I heard they changed the rule. What was the rule before? Anybody know? In typing, is it two spaces or one?
I thought 2 was cheating.
No.
Make your papers look longer than they actually are.
Oh, before it was 2 spaces if you're doing it on a typewriter, but now
Exactly.
1 is the standard.
So now it's 1. I guess that's the way I remember it, because it used to be. You're right. It's 2 and I took typing years ago, and it was actually through a typewriter, but not an actual typewriter. It was a word processor, I guess, but same thing. But you're right. So that rule doesn't apply anymore. I'm not going to take any points off for that because that rule changed. So for federal tax case, the three categories are, now this one again, you can use bullet points, if you want to use bullet points. You see what I did there? I clicked on you see on the bottom, there's a maximize. That lets you use additional features. You see now it's bigger. Now you see how it has, different, formatting. Yeah, because I'm providing a list, I should use bullet points, right? Again, use your judgment. Complete sentences, but if you're providing a list, then of course you can actually that doesn't have to be, the list itself doesn't have to be in complete sentences. So what are the three categories? What's the first one? Statutory, right? Examples of statutory include what? Anybody?
Internal Revenue Code.
Yes, that's what I was going to say first. The Internal Revenue Code and treaties. Right? And please do not say the IRS code. I'll take off points if you say the IRS code. Administrative. I can't even spell. Examples of administrative include, what would it be in here? Anybody?
Treasury regulations,
Thank you. Treasury regulations,
revenue procedures,
revenue procedures, revenue rulings, and what else? What else? Private. Let's just leave it at that. Private letter rulings. Right. And that's it, right? So that's it for that list. And then we have judicial, right? Examples of judicial include U.S. Tax Court, right? U.S. District Court, U.S. Court of Federal Claims, U.S. How about the Circuit Court of Appeals? How would I, write it here? Regional and federal, right? And wait, I could say the U.S. Supreme Court. They were in the news recently. You guys here? No, come on. No, you know what? It bothers me when I see stuff like that because it's like people are getting, so lazy nowadays. So no. It's come on, people. I mean, I get it. It's shorthand. I get it. When you're taking notes, people use shorthand as they're taking notes. In my opinion, I think it looks unprofessional in an actual document, in an actual article, to use shorthand in an actual article. But I get it. That's the norm. It's acceptable. But when you're actually writing, I think it should be clearer. If you are going to use abbreviations, then going forward. So how would I say it? U.S. Whatever. Use my abbreviation, and then just put it in Supreme Court. Yeah, there you go. There you go. So something like this would work if I started out with by actual, by actually typing it out and then parentheses SCOTUS, and then as I'm referring to it going forward in that document, then that's acceptable. But if I take this part out and I just put and SCOTUS, I know what you're talking about. I just doesn't, in my opinion, I just it doesn't look clean when you're writing the paper. Maybe it's just me. I'm a bit, anal retentive when it comes to that. I'm like, I want to see it out. I don't mind if you use shorthand going forward, but it would have to be this way. Then SCOTUS, you can say that SCOTUS going forward. So I guess the only shorthand that I would allow you to use in this class would be IRC, Internal Revenue Code, right? And regulations, you can just abbreviate reg. I know what you're talking about. A revenue procedure, RevProc, revenue, stuff like that, or PLR for private letter ruling. I know what you're talking about, but I don't know. It's maybe it's just me. A continuation with this question. I know I didn't ask you this question, but let's say I was asking you the difference. Then secondary sources do not carry weight, but are useful sources to use for reference, right? For reference. Um, so get something like this. I'll say examples. Examples include articles, textbook. What else? Tax, U.S. tax guide. Uh, what else? Um, CPE webinars / seminars, lectures, YouTube videos. Wait, what's my YouTube page? Anybody know? I'm typing it out in case you wanna go there. See if that link works. You don't have to type in and your YouTube channel. You don't have to memorize this. Although, if you do memorize it and put it as part of your answers, I'll give you 1 extra credit point, maybe 2 extra credit for that question. I think that seems fair. If you actually get the
Like
address.
2, and it's a deal.
but here's the stipulation. The condition is you also have to my page. That way I know you're actually serious about everything. I'm sort of kidding about that. Sort of in a way, but if you do something like that, I will give you 2 points, and you got to subscribe to my page as well. But you guys get the gist of it. Anything you find on the internet, even if they're reliable sources, even seminars itself, lectures, those are not primary sources. Those are all secondary sources. That's not to say that you can't use them for guidance. Very good lecture videos out there, are good reference material. I use a lot of these reference materials myself. The articles are good, easy to read. U.S. tax guide. If we were live, I would actually show you the tax guide that we use in practice. Maybe I can show it to you. Give me a second. So it looks. This is called the Bible, I guess. I don't know if you guys can see it, but it looks. Can you guys see it? Well, actually, let me unshare the screen real quick. You guys see it? This is like the tax guide. It's very fine print, but it's good because it has a lot of code sections. This is what we use. Everybody uses in practice. This one is CCH. It's a different provider, but very good reference material to have. This itself is secondary source, not primary source, but it does have primary source in there. It has a lot of case law and so forth. If you use something like this before, that's good. Good to use. If not, that's fine. Anybody use something like that before? A similar tax guide or reference material? No. Okay. Let's close this question. Back to the question. Now you see on the bottom that maximize, minimize the toggle button on the bottom. You see it? I'm gonna click on that, and that's gonna bring me down. It's gonna minimize it. Now I'm back to the regular screen. Now you see on top, it's save. Always double check to make sure it's saved. Again, it should do it automatically, but just double check. All right, the rules for cancellation of indebtedness. Generally, cancellation. Wait, that is considered I just say is income, right? exceptions include, and I guess I could put the same thing, the bullet point. Exceptions include, no, not, that's not where I wanted to put this. There you go. All right, what are my exceptions? What's under cancellation of indebtedness? Everything is considered income except, what's one exception? Bankruptcy, right?
Bankruptcy.
Yeah, bankruptcy.
Now, what if you don't list them all? You just, for some reason, you just forgot one. Are you due?
Well, again, these questions, I'm not gonna. It's more of the content. I'm asking you these questions because these questions do come up, and I'll give you a set of facts where you're able to determine if it's income or not. But that's the reason why I'm reviewing it. I don't require you to remember all of them, just as long as you have an idea. You hit on bankruptcy. The other one you probably think is insolvency. So it's very, very few situations. And just as we go over this list, just think about this list, and that pretty much is very limited on what's included as an exclusion. Everything else is income. So that's the way I want you to think of it that way. So we have bankruptcy, insolvency. What else do we have? It's, uh, yeah, again, certain student loans. What else? Principal, mortgage, forgiveness. But with this, it has a cutoff date. What's the cutoff date? It's
December 31st, 2020, I think.
up till this year. It'll probably get extended 2020, regardless of what Congress, whatever whoever's in office, president and in Congress. I'm pretty sure stuff like this will get extended. Even if they don't extend it this year, they'll extend it next year, and there'll be one of those retroactive. Or they'll do something what they did, recently, and this year they'll extend it a couple years from now, but it'll get extended. I don't see any reason why it wouldn't get extended. Even considering, I'm surprised it didn't get extended as part of the CARES Act. But we'll see what happens. That's pretty much it, right? Right? There's a there's a couple. Yeah, there's corporate loans, from shareholders. So this is like convertible debt instruments. All it does is just changing, which is fine. It's very common for closely held companies for the shareholder to get, issue a loan to the corporation, and then they just convert it to equity, which that's all that is. It's if you think about it, that's sort of just a journal entry on the financial statements. You're going to debit the payable and credit the equity side. It all it has an effect on is, that side of the equation. Your assets are still the same. It doesn't change anything that relates to your assets or anything that relates to your income statement. So it's usually a convertible instrument, but that's it. Correct, correct, and that is very common. So it's again, it's mostly smaller companies. Now again, am I going to ask you this question to list them? No. Am I going to give you facts? Where something is canceled. If I say this person entered into an agreement with their credit card company, they previously owed 10,000, they settled for 2,000. What happened to the $8,000? Just on those facts given, are you able to tell me that that's considered income? Yes. Just look at it that way. I'm not going to ask you to give me a list. Rather, I'm going to test you on understanding. If it's not part of this list, then it's considered income. Again, and don't add the facts to what's given. Use the facts given. Do not say, well, if this person was, insolvent, then it's not income. Well, in practice, you will ask those questions, but on the exam itself, if I didn't give you any facts that relates to her being or him being insolvent, then it's considered income. All right, so let's, pretty straightforward list. Number 8. This one. Again, I'm not going to ask you to provide me with a list. Instead, you're going to ask questions that what's an itemized deduction. The following are itemized. Oh, are how about how am I going to word? Are allowed as personal are the following personal expenses are allowed as itemized deductions. So we have medical expenses, right? What else?
Certain taxes.
Yeah. Now with this one, I'm going to again state income tax and real estate tax. It is certain taxes, but I want you to know what they are. What else?
Mortgage interest,
Yeah, mortgage interest. Um,
Um, theft or
gambling,
loss in federal disaster areas.
yeah, casualty. Yeah, I guess you're right. Casualty, theft, losses, and federal disaster. I just say federal. How about we leave this part out? But you're absolutely right. The reason why I want you to leave out because it is specific to a specific taxpayer. It's very specific. The deduction itself is very specific, but now it's even more specific. It's very specific. Okay, I'm trying to be funny, but it is very specific. Yeah, and it is an unusual event, and usually an act of God. That's how it was before, but now it's specific to federal disaster area. So you're absolutely right. But right now I'm more focused on what are the, that's not included for a common taxpayer. What's included for a common taxpayer? Somebody's going
charity,
charity. Yes, thank you. Charity to qualified organizations. I'm gonna organizations. Right. Somebody said this before. I don't know who that. Somebody in the background gave me something.
Gambling losses.
Yeah, gambling losses to the extent of gambling income. Right. Right. That's it. Now, again, we haven't covered itemized deduction in detail, but we have been talking about itemized deduction since day one. From what it sounds, I think mostly everybody can identify what's an itemized deduction. Again, I'm not going to ask you to give me a list. I'm going to give you different types of expenses. You're going to have to determine if it's an itemized deduction. And not only that, you have to understand how does that work. We covered this in day one of our class. When you're figuring out taxable income, again, gross income, everything's included in gross income except when it's not. And then we have deductions for AGI, which the only deductions that I've really gone over so far, basic deductions. Capital losses, we talked about that. If it's an allowed capital loss, that's a deduction for AGI. Alimony, if it's before 2018, deductions for AGI. And traditional IRA contributions, deductions for AGI. That's pretty much it. Now, I know we talked about rental losses last session briefly. That is a deduction for AGI, but we're not going to talk about that until after the midterm. We're going to talk about that in more detail after the midterm. But now, so far, in terms of deductions for AGI, again, we have traditional IRA contributions. If there's a capital loss, that's limited to $3,000, right? And what else? What else is included as far as another deduction for AGI? Alimony, right? That's pretty much it in terms of that list. I know I gave you a whole bunch of other items, but right now it's going to be easier for you to remember what's on that list for AGI. Deduction from AGI, these are my deductions. So we have gross income minus deductions for AGI equals adjusted gross income. From your adjusted gross income, we subtract the standard deduction or itemized deduction. That equals taxable income. And as long as you walk through it that way, you'll be you'll be doing a good job on the exam. Now, in terms of the itemized deduction, here's your list. Standard deduction that depends on filing status. For the tax return problem itself, the filing status is given. You just have to know: are we going to use the standard deduction or the itemized deduction? That's it. And then from the taxable income, you use the tax rate schedule, and then that's how you get your tax liability. We'll walk through that problem in a few minutes. Number one. But first, we got to do these two. Number 9 is a good one. Number 10 is also a good one. Describe the taxation of physical injury. Okay. Damages as it relates to physical injury is generally, no, I don't like that sentence. How would I say this? How would I describe this? Recovery, the tax ability, is that how you spell taxability? I don't know. That is how you spell it, I think. Anyway, how can I describe this? I need help here, class.
I will go back to the way you said for the damages for physical injuries are non-taxable.
Yeah, that's not the entire story. That's what I'm. For physical injuries are. I see. I guess the way I would put it, if I don't know, I'm having a writer's block right now. The taxation of damages of physical injury depends on the type of recovery, right? Compensatory damages are excluded from gross income. Punitive damages are included in income, right? Whereas all recoveries from non-physical injury are included in income. Now, again, I'm not going to ask you the question to tell me what it is. I'm going to give you facts. Let's say I tell you Homer Simpson got injured at, what's that? Where does he work? I should know this. Where does Homer, the nuclear plant, but what's that nuclear plant called? But anyway, let's say he got injured there. And part of his recoveries included, compensatory damages of $100,000 and punitive damages of $50,000. Based on that fact, what will be included as part of the income? It will be the $50,000. The $100,000 of compensatory damages will not be considered income. And let's say I further told you, additionally, Homer Simpson received workers' compensation and unemployment compensation. Workers' compensation is not income, right? Unemployment compensation is income. But as long as you're able to, describe it that way and tell me if it's income or not and why it's not income, then, you're fine. I'm not going to ask you to spell it out, but I just wanted you to see how, pretty straightforward it is. All right, number 9 or number 10 and number 1 contain problems. These are short answer problems. So what I'm going to do, I'm going to copy and paste this to a spreadsheet. Is that what you would do if you were me? And now I'm going to open up a spreadsheet. Okay, here it is. Copy, paste. Oh, no, it's too small. Let me change the font. 10. Well, there's a lot of facts there, but I think we can, break down the facts, right? So we have, how am I going to list it? Again, the spreadsheet that I created was something like this. Personal days, right? Rental days. Now, in this set of facts, personal days is 20, right? Rental days is 30, right? Personal days 20. Is that more than 10% of 30? Yes, right? Is 20 more than 14? Do we have a vacation home or a rental property or not income? Well, it's more than remember when it's more than 14, it's income. You have to determine if it's a vacation home or if it's rental property. In this case, personal days is more than 14, right? And 20 is also more than 10% of rental days. So it's a vacation home. So we have rental income. Well, let me set it up this way. I'm going to add a couple more spaces. Let me maximize it a little so you guys can see. So rental income. And remember how we said before, something like this category was vacation home. And then over here we have personal, right? And then over here is tax treatment for personal, right? Something like that. And then we had category one, right? Category one was interest and taxes, right? Category two was what? Other expenses, right? Category three, depreciation.
Depreciation.
Okay, depreciation. All right. So everybody okay with it? I'll worry about the formatting later. So let's just put the numbers in first. Actually, let's put the let's just do some of the formatting right now. At least the number formatting. See on the bottom. That's as far as what you want to do it. I'm gonna wrap this. Okay, that's better. So vacation home. The rental it's 3,500 for rental income, right? And over here I'm actually giving it 2,000 in taxes, right? So taxes was I'm gonna put it here 2,000, right? I'll leave it there. And then we have 1,000 in other expenses. Again, I'll give you those other expenses. You just have to tell me what to do with them. And then we have 5,000, right? So the ratio for interest and taxes would be what? What would the interest and taxes ratio be? So this is going to be what? Anybody know? Tax court method, yes. You mean rented days? The rented days is always going to be on top. So rented days, that's going to be, so the equation is going to be, I'm just going to say 30 over 365, right? And how about other expenses? That's going to be 30 over what? 50, right? Again, the bottom number is total days, which is 30 plus 20, right? And over here, again, I'm going to say 2,000 times 30 over 365, right? That equals 164. I'm actually going to make that into a negative, so it can work out that way. Over here, for the other expense, that's 30 over 50. So I'm going to change this equation. That equals this times what? 30 over 50, right? I don't think I did this one right. 2,000 times 30 over. I did. Okay. And then, so for this one, it's going to be the same way as this one, right? 3,000. I'm actually going to make it minus sign. There we go. Now we can actually see if it works. So we have this plus this, right? Or minus, right? So 3,500 minus 164, we still have enough to use in the next category, right? So now we have this minus the 600, 27,336. So this is limited to that, right? So net income is what? 0, which is it's this plus that. Remember, net income cannot be below 0, right? Now, as far as the double lines, that's really up to you, but I'm going to put them anyway. And I'm going to put double lines here just because that's what I did. Now, personal expenses. So we have this minus the 164 plus, right? And then over here, now for this, it's going to be 5,000. Well, how much was it before? So let's say
3,000.
3,000. All right. So very good. So 5,000 minus 3,000. So over here, itemized deduction. I'll just say itemize, not deductible, right? Pretty straightforward, right? And then in my explanation, I'll say something like, the question will ask, what's the amount not allocated to the vacation home is treated? So the amount not allocated to the vacation home for interest and taxes of 1,836 is personal, and then what? Deductible as an itemized deduction. The personal portion of category 2 and 3 are not deductible, right? That's it. Now, in terms of formatting, I don't like. Actually, it's supposed to be. That's not what I wanted to do. Merge. There we go. Now, how would I copy and paste this? Highlight whatever I need to. Well, before, let's do a little formatting. Again, don't spend too much time on formatting. To the extent that you have enough time, you can do that. But it's really up to you.
Do we need to mention the excess depreciation?
Oh
being carried
yeah, I
forward?
forgot. I probably would ask you that. So yes, what happens to that amount? So yes, I'll probably ask you that. If I do ask you that, again, same as before. If I ask you that, yes. If I don't ask you that, no. So how would I copy this? Highlight what I'm going to copy, right? Right? Control C, or copy, however you want to copy. Now I'm going to go back to the screen. Oh, you guys are not seeing it. Oh, there it is. And then again, you can use it, maximize it. How would I paste it here? Paste, right? Control V if I'm using shortcuts, right? And there's your answer again. If I'm using shortcuts, if it's I don't know how many people are using Mac. There's a different command for a Mac. It's not Control C. It's Command, right? Command. And other features, if you're using a Mac, whatever the features is to control and paste, that's what you're going to use, and this is how it's going to be. Then it saves it, the same as before. Save. Now it's there. Now let's go to the first question. Again, the question I would ask you for this one, you can probably copy, paste it. It's up to you, or make notes. That's fine. It's really up to you. So in this set of facts, I'm going to copy. I'm going to put this on the bottom here. All right, paste. That's not what I wanted to see. Okay. What did I do? Well, anyway, let me go back to the way it was. Here we go. So we have gross income, right? Gross income, right? What's included in gross income? Salary, right? Salary 25,000, right? Interest from Illinois bonds, is that income?
No.
Okay, corporate dividends, is that income?
Yes.
Corporate dividends is income. Anything else? No, right? So total gross income equals, again, I'm trusting that many of you would already know how to use the sum commands. So then dollar sign. Okay, what's next? Deductions for AGI, right? And there's only one here, IRA contribution, and that is 3,000, right? So AGI, adjusted gross income. So that is, I think I asked you this question before. Same question, right? Itemized deductions. We have itemized deductions of 10,000. Standard deduction for 2019, 12,200. Well, what are we going to take? What do you guys think? Yeah, standard. Everybody should know this by now. Standard deduction. Again, minus 12,200, right? Taxable income equals this plus that, right? And now I'm gonna just exactly 10,000. Wow, look at that. Now I'm gonna make it look, somewhat nice. But this is not the only thing this is the only thing I was asking for in this particular problem. But in my problem, I'm gonna ask you to, so something like this, this is not the end of it. Now I have to figure out the tax liability. But since I'm only asking for this right now, let's just copy and paste this now. Back to the screen. So we got to go back here anyway. All right, paste, right? There it is. Now, since we're here, what is the tax? Actually, this is actually pretty straightforward. The taxable income is 10,000. Where do they fall in here? Anybody? I need help here.
Second line.
Second line, which is the 12% tax bracket. So this is how it reads. Of the amount over 9,700, that's taxed at 12%, right? So of the amount over 9,700, that's taxed at 12%, right? And then we're going to add 970 to that number, right? Okay, pretty straightforward, right? But now I'm going to go back to the spreadsheet and put that into an actual spreadsheet format. So we have the taxable income. So, all right, back to taxable income. And I can just say equals that, right? Now, of the amount over 9,700, right? So that equals, again, of the amount over, which is only 300, right? So the X is over 9,700. What are we going to do with that? I'm gonna say again, because I want to see what you're doing. So times 12%, right? So this 300 times 12%, right?
Mhm.
Dollars, right? And then we're going to, because again, I want to see your work, plus what? 970, right? So it's 36 plus 970, right? Total tax liability is 1,006. Now again, for that,
And you want it to be this detailed, even though it's like a head calculation?
Yes. Give me detail. Well, yeah, with this one, I do want to see detail. Yes, I want to see, because I want to see how you did your math. So yes, I do want to see this detail when you do your math. And no, this is not a computation. Of course, actually, with this one, yes, it is pretty much. You can do it, even though you can do it. That's not going to impress me. How do I know you came up with 1,006? I don't see the support for that. I want to see this. However you describe it, if you want to put it in words, that's fine. Now, if you want to do the numbers, by yourself and just describe what you did and put it in Word, that's fine. As long as you're able to show me your support on how you got to 1,006, that's what I want to see. Because this is tax cuts. I want to see the computation. So this one is going to be, what am I going to label this? I'm going to call this my income tax computation, right? And that's it. And again, I'll give you the withholding and the tax liabilities. You have to know what to do with that. Highlight that. Put it over here on the bottom somewhere.
I have a question. You mentioned earlier about the the credits. What section do you put the credits in? Like at what point in this process?
Good question. On these facts alone, are there any credits?
Oh, not for this one, just in general. If they talked about dependents.
Yeah, that's a fair question. All right, let me make it simpler. Let's say Nathan was not head of household; he was single, and Nathan had who should we? Oh, I got one. Let's say Nathan claimed his significant other. He's able to claim his significant other. His significant other lives with him for the whole year. She has no income. Then in that case, how would that work? Those are non-refundable credits. So once you figure out, and I think that's what you're trying to ask me, how would I apply? So here's my tax liability. The tax liability is going to be more than enough to apply the credits. So you don't have to make that distinction between refundable or not. You have more than enough tax liability to cover it. What I will test you on, knowing which credit to use, $2,000 or $500 credit, right? So over here, $2,000. So that's my, since we're on the topic, actually, let me move it over here. So the tax is 10,000. Then we have, again, let's say he's able to claim his significant other. What credit does he get? The 2,000.
500.
Yes. So credit for dependent credit. Let's just call it dependent credit. Dependent credit.
So the credits applied to the actual tax in the process. Okay.
Yes. So, and then in this case, we're going to say this is actually your tax. Well, again, I'm going to make it simpler for you right now because we haven't talked about the difference between refundable and non-refundable credit. In this case, it's not going to matter because think about right now, the dependent care credit, it's a non-refundable credit. $1,000 is more than enough to cover this credit. If the tax was $400, the most you can get for the dependent care credit or the dependent credit or any type of non-refundable credit would be whatever your tax is, $400. That's, right now you don't have to make the determination. But what's the one refundable credit that can exceed your tax liability? And you probably don't think of it as a credit, but it is. We did talk about this. What is one item that can generate a refund? How about just the payments, federal payments? So let's say federal income withholding, not FICA taxes. FICA, that's not included. So income tax withholding, let's just say that's 600, or in this case, 600. So in total, they have credits of 1,100 even, right? So what happens here? And that in this circumstance, $500, they get a refund, right? As long as you're able to determine, understand this concept, in terms of the credits, it would just be limited to knowing how to use a $500 credit or $2,000 credit. That's it. And remember, most of the times it's going to be the $500 credit unless the child is under the age of 17. So then you're going to use a $500 credit. Then $500 credit times each dependent that they qualifies. You don't get $500 for yourself. You don't get $500 for your spouse. The $500 is actually for a credit as a dependent. Your federal withholding, that's your income tax withholding, and then that's also your estimated payments that we're going to talk about in more detail when we cover your self-employment tax. Yeah, that's what you would do. I'm actually glad that you asked me that question. And then you would show me the math here. This is what the refund is. But let's just say the federal withholding was $400. In this case, $400. They're going to owe, right? Tax due. As long as you're able to determine that and know where to use the numbers, that's it. That's the extent of what you need to know. Going forward, even going forward on the final, I'm not going to ask you any questions specifically on credits, just the $500 and the $2,000 credit. And I'll ask you other questions that relate to self-employed individuals.
Why wouldn't they apply the federal income withholding first before the dependent credit to get you to zero rather than issue a refund? Or is there an ordering rule on that?
I just explained that to you. And then there's an ordering rule right now. I explained it to you a few minutes ago.
Sorry if I missed that.
The the dependent credit, it's a non-refundable credit. You're always going to apply the non-refundable credits first. Always. 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 The refundable credits, you're always going to apply them last. The goal is, think about this for a second. Keep in mind that when they're taking taxes out of your paycheck, they're just estimating how much taxes you're going to owe. That you're either estimating that you're going to owe more or you're going to owe less once you file your taxes. So let's say when you make your withholding, they took too much money out. What happens? Is it fair for the government to keep the money? No. What happens to that money if you overpaid the government? You get it as a refund, right? Why would the government keep your federal withholding? They can't. They have. That's used to apply against your income tax. The non-refundable credits are different. Non-refundable credits. There's different types of scenarios, different types of non-refundable credits. You always apply those first. And even taking it a step further, there is an ordering rules regarding the types of non-refundable credits, which credits get applied first. But just what I want you to know so far, and I guess it's shorthand, always apply the non-refundable credits first, because the goal for the non-refundable credits is to get the tax liability to zero. That's it. The non-refundable credits cannot exceed your tax liability. Remember how I said it? Let's actually use these facts, and let's just say the tax liability here was $400. Based on what I just told you, you're applying the dependent care credit or the dependent credit first, the credit for other dependent first. It shouldn't be $500. What should it be? It's a non-refundable credit. It cannot exceed the tax liability. What should it be? Anybody?
$400.
$400. You can't go below zero. Now you're getting your withholding back. It's designed that way so you can get your withholding back. You apply your credits first, and then in essence, your withholding, you get that back. Let me, I guess
I actually have a question about this.
To bring it home, think about this for a second. And this is a question that people people ask, and this is a common discussion that people have regarding refunds. Let's say somebody got a refund of $10,000 compared to somebody getting a refund of $1,000. And let's say the refund is just pretty much exclusively and solely on the withholding. Who did a better job in tax planning? The person that's getting a $10,000 refund or the person that's getting $1,000 in refund? What do you guys think?
$1,000.
1,000.
Why? But you're getting $10,000 money back.
But you loaned it out at zero interest for most of the year.
Exactly. That's it. And this is the thing. There are some tax preparers that plan for their clients to withhold a certain amount, over withhold, so they can get a big refund at the end. I think that's bad tax planning because you're having them take too much, a lot of money out. You're giving, like you mentioned, you're giving the government money loan. They're not paying you the money. They're paying you the money back. You get it back, but come tax time, they give you exactly what you overpaid them. How about if it was the other way around? Let's say you underpaid them and you owe them. What's going to happen in that case? Penalties, interest. Doesn't seem fair, does it? Unfortunately, it's not fair. It's not supposed to be fair, but that's the way it is. A refund solely, mostly on your withholding. It's a loan that you're giving to the government, interest free. The other taxpayer did a better job in tax planning because he kept more money or she kept more money in their pocket on each paycheck. They had more cash flow. That they're in a better position. They're in a better position to use that money to spend on cash, whatever they needed in those during that time period. Again, that's what I think. In my opinion, you should never plan to get a super big refund. It's poor tax planning. You're giving the government money free, and they're giving it back to you, but it's interest free. All right, you had another question. Somebody had another question, and the refund.
Yeah, I was just saying, like, I think Dan asked something about this, if it was ordered or not. It's more that it wouldn't make sense not to use the non-refundable credits first. It's like, as a tax preparer, that's always the best choice. So you're always going to apply it in that order. Not so much that the IRS or the Internal Revenue Code says you have to apply them in that order.
But you do have to apply them in that order.
Okay, so the code does say you have to apply them in that order.
Yeah, you have to apply them in that order.
Well, I know you never shouldn't. I just want to know if it was by convention or by
no, you have to apply it by order. It's an order. It is an order. It's in the code. It's actually listed in order. And again, even in the code, it gives you specific code sections on which credits get applied first. That's how detailed it is. Yes, it should be applied in that order. Non-refundable credits go first. And then even with non-refundable credits, there's a specific order non-refundable credits go. I'll give you a hint. It's pretty consistent with the way the 10 form, the form 1040 is set up. Remember, even though I said the code itself, the form itself and the instructions to the form, that's not primary. It isn't. But the form itself, it is set up the way the code is. If you think about it. And I'm actually glad that since we are having this discussion right now, let's sort of, walk back in time to basic formula that I gave you way back when. Remember that formula that I gave you way back when regarding the tax reform model? I'm gonna put it on the screen again because this is in the code. Again, it is there for a reason here. Gross income, section 61. There are some deductions for AGI that's listed in section 62, but there are others in section 62. So gross income, that comes first. Section 61 comes before section 62. Section 61, which tells you everything is considered gross income minus your deductions for AGI. We talked about a couple so far. That equals your adjusted gross income, section 62. Again, even if you look under these code sections, under 63, it does tell you, you look at your adjusted gross income from section 62 to subtract standard deduction and itemized deduction and so forth to get your taxable income. It is in that order. Even this formula itself is in that order according to the Internal Revenue Code. Now, even let's just take it a step further and sort of talk about the way the form is set up. I want you to visualize the way the form is. I know I showed it to you last week. The first page, that has your name, heading, social security number. And then after that, like on the bottom of the page, then it starts talking about what? Actually, rewind. First thing is, if you sort of think about it, this is the order of the way you're preparing tax returns and the order that you're gathering information. On top of the form, you have the name of the taxpayer, the social security number, their filing status, their dependents. But what do you think that's first on the tax form? Why do you think that's first? Because you're supposed to get that information first in order to figure out the correct filing status, in order to figure out the standard deduction, in order to figure out the correct tax bracket. So that should always come first. And then after that, the next section is what's gross income. The whole section on gross income, that's section 61. And then we have the next page, a couple deductions for AGI, or more specifically, part of 61 and part of deductions for AGI, those are Schedule 1 items in a separate schedule. Again, it's for that reason. Again, 61, additional gross income item and deductions for AGI, that's on Schedule 1 and other schedules depending on the circumstances. That equals your adjusted gross income. And then on page 2, actually no, page 1 now, it has your standard deduction and your organized deduction. And 63C comes before 63D, right? That's the way it's applied. And then 63E comes next, right? C, D, E. What's E? Section 63E is a relevant section of the code. But again, standard deduction 63C, that comes first. If you think about it, you think about the filing status first, you think about the standard deduction first. And then you ask yourself, if they itemize, that's more than the standard deduction, then you use an itemized deduction. Section 63D does give you a partial list of itemized deduction, and then it cross-references to other sections. And that equals taxable income, 63. So the tax rate itself, you would think the next one to figure out the tax liability would be 64, right? No, it's not section 64. You know what's to figure out income tax liability for individuals? You know what code section that is? Section 1. But it all goes in that order. Again, it may not be like for the most part, it does follow this flow. Except once you do 63, you figure out the tax liability. You go back to section 1 because that's how you figure out the tax, liability. And then as far as the credits goes, it actually goes a little bit backwards. The credits itself, they're in the 20s, the 30s sections. So 20 section and the 30 section, depending on the code section, those are where you're going to find a lot of these credits. Most of them are listed there. Again, it's not exactly in the order it should be in terms of the code, but the format is still the same. You're always going to apply non-refundable credits first. That's how it works. You apply that first. Because if you apply your withholding first, then if you think about that for a second, your non-refundable credit would be less. It's still limited by your tax liability, but think about that for a second. Just the whole concept itself, it's wrong. You're applying your tax liability, but non-refundable credit is to reduce your tax liability to zero. That's not the goal for the refundable credit. The refundable credit is to reduce it to zero and possibly generate a refund. If you do it the other way, it's sort of you're doing it, backwards. You're applying the refundable credit first, and then you're applying the non-refundable credit. It's just doesn't make any sense. It should be done in the order you see the forms and the order the code is written. It is by code section. Everything is by code section. So since I talk about section 63E, anybody know what that pertains to? Nobody? I'll give you one extra credit point if you give me the answer without looking it up. Okay, I'm not going to tell you then.
Damn it.
All right. We're back to the question, and I still have time to spare. All right, so now you see on this question, you see on the left-hand side how they're all checked. That means they saved it. Now you see how it has a timer left? That means I still have less than an hour to go through it. I encourage you to, if you have time left, go through the questions again to make sure you feel confident. But again, the question that you asked earlier in terms of how much detail, within reason, provide enough detail that you believe that you answer the points given, but not too much detail. Short and concise, but with substance. That's the best way I can put it. It has to be substance, and there has to be enough information. Like again, like for example, this question itself was pretty short and sweet and answer all the points that I wanted to that you wanted to answer straight to the point. Again, use your judgment on that. I don't want you to spend too much time on one question because there's a lot of questions. Let's say the vacation home is one that you need help with. Then of course, if you know how to answer these questions, the short answer questions quickly, answer those questions, and then spend some time on the vacation home because that's going to take you some more time. As you see, question number 10 and question number 1, that took us more time than the other questions, right? Again, just make a judgment on that one. Any other questions? And then you click submit, and then you submit it. All right. Okay. So that's the midterm or practice midterm. I hope you had fun with the practice midterm. What else was I going to ask you? I was going to ask you something. Actually, I know I said I wasn't going to cover new stuff, and I'm not. I wanted to do the net operating loss problem, but I'll wait until, because I'm not going to test you on it. I'm going to wait till after the midterm. So next Wednesday, I'll go over that. So for today's class, I want to do one other problem from, hold on, there it is. Remember in chapter 3, I told you to look at that problem in back of the chapter? Chapter 3. Hold on, no, wrong chapter. The tax return problem for more practice. Let's go do that one real quick in chapter 3. We went over one. I think I only gave you the answer for one, but I'm going to give you the answer for the other one as well. Okay, give me a second. It's taking a minute. This is the one we went over last time. Okay, I want you to get in the habit of doing this all the way through, because the problem that I'm going to give you, that big problem on the final, I mean, and the midterm, is going to be something similar to this. It's going to have a lot of facts. You got to pull out what's relevant and what's not relevant. Let's actually walk through this one real quick. 52, and sort of walk through the answer and see what's income, what's not income, and figure out the answer together. So this one, Logan Taylor is a widower whose wife Sarah died in 2016. So keep that in mind, 2016. That's relevant to the information. Then it has salary, that's income. Regarding this interest income, of those items, is there anything that sticks out that's not income? What do you guys think? There's something that's not income. Anybody?
The city bonds.
City of Springfield Fund.
Springfield bond. Oh yeah.
Yeah, the $3,000, that's not income. Very, very good. That inheritance from Daniel. Who's Daniel? All right, so Logan inherited securities worth $60,000 from his uncle Daniel, who died in 2018. So we're doing the 2018 tax return. Well, let's finish reading, but I think we already know what that is. Logan also was a designated beneficiary of an insurance policy on Daniel's life with a maturity value of $200,000. And the lot in St. Louis was purchased on May 2nd, 2013 for $85,000 and held as an investment. Because the neighborhood has deteriorated, Logan decided to cut his losses and sold the lot for $80,000. Huh. Think about that for a second. The estate sale consisted largely of items belonging to Sarah and Daniel, camper, boat, and so forth. Logan estimates that the property sold originally cost at least twice the $9,000 he received, and he has declined or stayed at the same value since Sarah and declined and it's stayed the same value since they died. That's relevant regarding the basis when we talk about that in property transactions, but not so much right now. All right, so let's see what else is here. Second page. Um, all right, so regarding the inheritance, the $60,000, is that considered income? The $60,000, is that income? Again, I'm going to give you back.
Sorry?
Is it income? No, it's
No.
not income.
No.
Gifts and inheritance, that's not income, right? So that's not income. If he later sells it, then that's income. So when he inherited something, that's not income. Now, what about this life insurance proceed he received as a lump sum payment instead of receiving periodic payments? Is that income? Not income, right? So that's again, death benefit rules. We talked about section 102 and 101 so far. That $200,000 is not income. Now, what about this $80,000 lot that he sold? He bought it for how much did he buy? $85,000. He had it since 2013. That's more than a year, and he sold it for a $5,000 loss. This is not a personal use asset, is it? What type of asset is it? What do you guys think?
Investment?
It's a what?
Investment asset?
And that's not the answer I was looking for.
Capital.
Yes, that's the answer I was looking for. Remember, for you're right. It is an investment asset, but for tax purposes, you have ordinary income asset, which that's your accounts receivable and inventory. It generates ordinary income. And then what do you have? You have fixed asset, which is your 1231 assets, and then you have a capital asset, which is if it's not one or two, it's a capital asset, right? This makes it a capital asset. You're right. It is an investment asset. Investment assets are generally capital assets, but not all investments are capital assets. Just keep that in mind. In terms of the capital asset, because it's not a personal use asset, they're able to deduct how much per year? There's a number that should, stick out.
1,000.
3,000, right? At $3,000 per year. So of the $5,000, only $3,000 is deductible. The full amount, now $2,000, is carried forward until it's used next year. All right, so that's it for the 85,000. So what about this? Oh, $9,000. All right, so this is the interesting part. Estate sale. So Logan receives something that's worth. So again, the estimates that the property sold originally cost at least twice the $9,000. So this is a estate sale. When it comes to estate sales, what do they usually sell? Do they sell investments there? What do they usually sell in estate sales?
Bonds.
Well, yeah, that's part of it. But what else in terms of assets itself? They usually sell personal use assets, right? They'll sell furniture. They'll sell maybe art that's collectible, but a lot of it is personal use asset. I don't see anything in terms of what type of information it's in here. I don't have enough fact on the estate.
Would it be a capital asset he didn't
Well, here it does.
hang on to for a year?
What's that? Well, let's read on this. The estate sale consisted largely of items belonging to Sarah and Daniel. So these are personal use assets, right? And they were sold for less than what they paid for it. So it's actually at a loss. We don't have enough information on that, but that's it's considered a wash. Well, not a wash as we know it, but that's not deductible. It's a personal use. It's a personal. It's like he sold a personal use asset. Can we deduct the loss on a personal use asset? No, right? The $9,000 loss that we have here, approximately, that's not deductible. All right. In terms of, did somebody have a question? I think somebody had a question.
But it's not income either, right?
No.
Okay, that's what I thought.
Yeah, no, again, they made a sale. Um,
I mean,
yeah,
I guess
just
they
on
had
these
one.
facts alone, but keep in mind, just on these facts alone, but some estate sales, I think, can generate income, like if they sold it for more, or if they actually sold it at a gain, yes, if they sold it at a gain, then that's income. And then some items will generate, taxable event. But we don't have enough facts on that. In terms of medical expenses, we have to see if it's above the floor. The taxes, state income tax, and real estate taxes, that's deductible. Well, everything here is deductible, right? So we got to add it up, see if it's deductible or not. Um, Now, what about dependents? I heard that. So Logan is so. So what happens here? Logan's wife died in 2016. In 2017 and 2018, possible qualifying widower. So we have medical expenses possibly deductible. Helen is Logan's widowed mother and who lives with him, see below. That's a $500 credit for the mom, right? Let's see. And then as far as the pledge goes, the pledge itself is not deductible. Actual making the payment is deductible. So that's included with the charitable contribution. Should we include with charitable contribution? Uh, yeah, there's the paid pledges for both years, 4,800. Yeah, the thing about that, for accounting purposes, it's when you make a pledge. For tax purposes, when they actually receive it, which is slightly different. All right, so we have the kids. Asher is 23 and Mia is 22. So Helen receives modest Social Security benefit. The son is a full-time student in dental school and earned 4,500 as a part-time dental assistant. And then Mia, daughter, does not work and is engaged to be married. All right, so let's look at the son first. Asher is not under 19, right? But is Asher under 24? Yes, right? Is Asher a full-time student? Yes. Again, Asher does qualify as a qualifying child, right? But let's think about Mia. Mia is under 24. Um, does Mia qualify as a dependent? Not as a qualifying child, right? Mia does qualify as a dependent, but as what? A qualifying relative, right? Again, just on these facts alone, what's the first test for qualifying relative? Gross income test. She has no gross income based on these facts. And based on these facts given, the who is it? Logan is supporting Mia, right? And Mia lives in the household, so Mia gets to be claimed as a dependent. So now we have Mia and Taylor. What is the amount of the credit that we're going to use here? Is it the $2,000 credit or the $500 credit? What do you guys think? Is it the $2,000 credit or the $500 credit?
500.
Everybody agree with the $500 credit?
500.
Oh,
Yes.
isn't for Asher? It's the two. No, it's 500.
Okay, what were you going to ask me? And
No, was it okay? So Asher is the one because he's in school, right?
yes.
She or he?
Well, I'll help you. I'll help you with the answer to your question. You answered your question with the question. You answered it correctly. But Asher is not the $2,000 credit, right? Remember that $2,000 credit is not for qualifying child. It's for qualifying child who is under the age of 17.
Gotcha.
When you think of the $2,000 credit, the age that I want you to think of is that 2,000 the under 17. So based on these facts, $500 credit for the mom, right? $500 Asher. I'm assuming that's son, maybe. I don't know. Mia, daughter. I guess Asher can be. Yeah, it's a son. Um, so 500, 500, 500, $1,500 credit, right? Based on these facts given, right? All right. let's read additional information. There was federal withholding of 4,500, which gets applied after the non-refundable credit. And then, yeah, this other information, if you want to do a memo, that's not what we're going to do here. All right, I want to show you the answer so you guys can see how it would look. Well, I'm looking up the answer. Anybody have any questions on this? Any additional questions? Any questions? Everybody okay with why is the $500 credit? Okay, let's again, you have to understand that the child tax credit is under the age of 17. It's always been under the age of 17. And I'm going to show, and for alimony, that's 2018 before. What question was this towards the end? 50.
I have a
52.
question just in general on the inheritance.
Mhm.
So like if you don't get, it's not considered income.
Right.
Didn't we talk about how like if someone gives you a car, you have to pay tax on it? Like, so is that just because that's not inheritance? It's just is it different?
Right.
It's just like a gift.
Well, the gift itself is. I didn't say when somebody gives you a car, that's if you receive it as a gift from your uncle or your mom, and that's not income. The gift scenario was something actually totally different. It wasn't as a gift. What was the scenario regarding? And I gave somebody. No. Well, no. That's still a gift. Remember, the donor still gives. Is still responsible for the gift, but regarding somebody giving you a car, it was in the context of a TV show, right?
Oprah.
Yeah. So if you win something as a prize and award, that was the context that I was saying. The reason,
Okay, that's helpful.
yeah, the reason why it's like if you go to the Price is Right show or whatever TV show, Wheel of Fortune, you win a car. That's considered income to you. The value of the car is considered income.
But
So,
like
yeah,
if my grandma gave me a car, I wouldn't have to consider that income.
that's not income.
Okay, that's
Your
helpful.
grandma most likely would have to file a gift tax return. Depending on her circumstance, there may be gift tax due or not, depending on her circumstance. But most likely, that's going to generate a taxable gift from her end. But when you're receiving something as a gift, that's never income to the recipient. If you receive something as an inheritance, that's never income to the person receiving it. However, if let's say your grandma gives you a car, you later sell that car at a gain. It's a very nice car. It's a collectible. You actually sold it at a gain. Then the gain is taxable. It's a separate event. But if you receive something as a gift, that event is not taxable. But you receive something, the subsequent event is a taxable event. You're asking me that question too early. For which situation? All right. So which as a gift?
So you were gifted it by your grandmother originally,
Okay.
and
In
then
that
you sell it for a
situation-
gain later.
In that situation, the general rule is going to be the cost of the grandma's cost, her cost, carryover basis. If it's a gift, that's the general rule. There are exceptions to the rule, but the gift, it usually assumes the basis of the person that gave you that gift. That's the general rule. Okay, yeah. Ask me that question again, but ask me if it was a person. It wasn't grandma giving you a gift. You inherit it because you passed away. So what's the basis then? What do you guys think then? I'll give you a hint. It is more advantageous for the recipient to receive it when somebody passes away than when somebody is living. This is known as the step-up basis. It's going to be the fair market value at date of death. So the fair market value date of death when the grandma passed away. That's a general rule. So fair market value as an inheritance, as a fair market value, it's actually very advantageous for the person receiving it. He or she can, sell it right away for exactly the same amount as worth. Doesn't recognize any gain or loss. It's still reportable, but doesn't recognize any gain or loss because up in basis. Just to give you a fact. Let's say my grandma passed away, gave me stock that she paid $20,000. It's now worth $80,000. I sell it the same day that I received it. I get it at the $80,000 as I receive it as an inheritance. It's a step up in basis, $80,000. When I receive it as an inheritance, that's not a taxable event. But I later sell it. That could be a taxable event, but I sold it for $80,000. $80,000 my selling price minus $80,000 my cost basis. What is my gain? Zero. Even though I have a reportable transaction, my gain is zero. So it's more advantageous for the person that's receiving the property to receive it as an inheritance as opposed to the gift. Those are the general rules, but it's different on a case by case basis.
Do you split it evenly? Like if a car or a house was left to like, 2 kids or something?
What do you mean?
Like, say like I don't know, you're hopefully not, but if your like parents passed away and they left their house to like multiple children.
Oh, and they each get it. Yeah, that's pretty common. So yeah, it would be split. If everybody gets. So let's say I have 3 brothers, so each of my brothers gets 25% of the house. So yeah, let's assume it's cut that way. So then we each get 25% of the fair market value. When they passed away, if we sell it the same day, then it's going to be no gain or loss because it's sold at the fair market value, assuming those are the facts. So yeah, that's actually how it's done in actual practice. So yeah, we each get 25%. And but even with that, what happens in a lot of cases, it's usually somebody would take possession and live in it, and they have to buy the other you know people out. So I would have, let's say I want to live in the house, then I would have to pay off my other brothers, to their portion of it. Is it a taxable event to them? Perhaps. If I pay them exactly what their cost basis is, then there's no gain or loss recognized for either one of them. If I gave them more than what it's worth, then they have a gain or loss. But you're absolutely right. It is split down the middle. 25% in my case, 25% for my other brother, and so forth. That's how it would be split up. So again, fair question. Now, in terms of property transactions, as far as the basis rules, it's good that you're asking me these questions now. But these questions are going to be covered in more detail when we cover property transactions in a couple of weeks. Now, in terms of the just estate itself and gift taxes, uh, those discussions are covered in more detail in the corporate and entity tax class. If you want to learn more about that, it is a fun, topic, and I hate to say the word fun. I should say more interesting, because there's a lot of things to think about. I shouldn't say fun. Fun is sort of a disrespectful way of saying it. It's I shouldn't say fun. It's interesting because there's a lot of pieces that you got to put together. It's everything can happen when somebody passes away. Not only do you have an estate itself that you got to file an estate tax return, and then you got to think about the beneficiaries and their basis. But sometimes the estate itself is still in existence for years. Think about some celebrities that passed away that's still generating revenue. So even though they filed the estate return itself and that's been finalized, there's still income producing property in the estate. So the estate itself has to file an income tax return. So it gets a bit confusing if you think about it. You file one estate tax return for estate taxes, but the estate itself can still exist to pay income taxes if they have income producing property. So let's say, for example, again, like these celebrities have residual income coming from royalties, from whatever movies they've made, from records they sold. They're still collecting income. That's income producing property. That's somebody has to file a tax return for that income producing property. Now, how is that taxed? Well, that's something that's covered in more detail in the entity and the corporate and entity tax class. Because again, I don't want to confuse you too much. Just know that a state itself is a separate entity, and that does pay taxes. So even though the person passed away, the state is responsible for paying the income tax and the estate taxes that are due. So that's how that would work. Now, here's the answer for this question. Again, pretty straightforward. Let's see, we hit on all the correct answers. Take a screenshot of this. So you can see how it's was done. $80,000 income. Everybody was right on identifying the interest from bonds. That's not income. Inheritance. That's not income. The insurance was not income. Now, I talked about that. That's that. What do they sell? That investment, real estate they held for investment. The most they can deduct is $3,000, right? To make sure
Not see
you.
the answers.
Oh, sorry. Uh, Thanks for letting me know. See, sometimes I just talk and talk and uh and I just go on and nobody tells me anything. All right, now can you guys see it? All right. Again, pretty straightforward. I think everybody, good job for everybody identifying what's relevant, what's not. Again, the city of Springfield bonds, not income. Inheritance, not income. Life insurance proceeds, not income. Remember that sale of that investment that was at a $5,000 loss? Only $3,000 is deductible in the current period. The rest is carried forward. The estate sale, that's not deductible because it's a personal use asset. The federal income tax refund is not considered income. Only the state income is considered. The state refund is considered income in some cases. Now over here, the itemized deduction, we went over that. It's pretty straightforward. Now the thing about this medical expense, the floors. Don't worry about the floors here. Don't even worry about medical expenses. I'm not going to give you medical expenses. We haven't really talked about it that much. But I will give you other expenses that may be itemized deduction. 24,720. That's actually more than the standard deduction in 2018 for qualifying widower, which was $24,000. We're going to take the 24,720. Taxable income, again, gross income minus your deductions for AGI equals my adjusted gross income of 78,400, right? Minus my itemized deduction, 24,720. My taxable income is 53,680. I use a tax rate schedule and figure out what my tax liability is. I'm not going to use a tax table. I use my tax rate schedules. I should come up with a number that's close to 6,060. Now, I see what you mean because over here they apply the credits second. You'll get the same answers first. You apply the credit first. Remember, I said it's $500 for each dependent. There's 3 dependents. 500 times 3, $1,500. And then the total. What happens in this case? 6,000, and they had tax liability of 16,000. They have a tax due of $60, right? That's the outcome on this one. Again, I don't think I have this on Brightspace as the solution. So take a screenshot of this. I don't. I think you should be able to annotate it from your end, but take a screenshot.
I actually think it is on Brightspace.
Is it?
If that's helpful to anyone. Yeah.
Oh, okay. So there you have it. Again, I really want you guys to walk through it in your own time, the same way we did it. Again, for your own, practice, because that's a big part of the problem. 40 points on that problem. It's going to be very similar to this. So do 50, do 51, and do the previous one that we did. And
Do you think I have a question?
but
Like when you put you did an example of I remember this that for qualifying relative and that we talk about community property states like Texas and Arizona and that there were 2 scenarios and in one scenario it was a young person and he was married and he had an income of $5,000
right.
and would you think you will include that like a scenario like that?
I'm not gonna test you on that. It's actually good that you understand how to apply those concepts. I'm not gonna test you on that because Illinois doesn't apply in Illinois. So it's good to know that. It's good to know, walk through that. If you see something like that when you're doing taxes on your own, you may encounter it. You gave me 2 states, and you're absolutely right on the states. But it's a selected few. Arizona. What's the other state that you said? Did you say Washington?
Texas.
Texas. Yeah, there's a couple more. But again, it's unless you have taxpayers that apply there, you don't have to always do it that way. Yeah, it would apply in that situation. And so if you're applying it to somebody who lives in Texas, go with that problem that we went over. It's in this chapter, I think, where it had the same set of facts. Where yeah, if it was the situation where it was a married couple, right, and
Yeah.
and then the other set of facts. It was in a regular state, and the other one was a community property state. The son was still the son, but it was the wife because the wife gross income was more than because the gross income according to community property state is more than that amount, even though she didn't earn it. I do want you to understand that, but I'm not going to test you on it. It's good to understand that rule if you see it in practice, but it's not something I'm going to ask you on the exam. Or maybe I should. Huh. Wait, Gabby, was that you? Who was it?
Oh, yeah, it was me. Sorry.
No, I'm kidding. I'm not going to ask you that. Basic dependency rules. I think for the most part, that's what I think you should deal with. It's good to know those rules, but I'm not going to ask you this on the midterm.
I had a question about if I know there's federal income tax, but like if I know that if you work in multiple states, you can be liable to pay taxes in multiple states at different rates and stuff like that, and it can get messy. But what about stuff like income, like interest income? Like, do you only have to recognize it in the state that you reside in, or what happens if you move halfway through the year?
Wait, I don't. Wait, what are you talking about? What income?
Okay, let's say that I have interest income. I have money in the bank, and it's generated some. It's grown, and so it's income, right? I have a savings account. But I lived in 2 different states that year.
What kind of interest?
Just interest on a savings account. Let's say I earned $100.
Okay. I think what you're asking me, in what state did you earn it?
Yeah.
Good question. This is a federal income tax class, so I guess that would be my first. But you actually, because the reason why I can't give you an answer because each state is different. How would you do it? I guess technically it would be where the bank is actually earned. I guess put it this way. And this is true in most states. So let's say I have I live in Texas. Texas doesn't have an income tax, so I don't pay any income tax on income that I earn in Texas. All my wages, salaries that's from Texas, so no income tax. Federal taxes, yes, but no income taxes. However, I have a partnership or an interest in a partnership from a partnership in Illinois. Where do I pay taxes? I'm not paying any taxes in Texas because there's no income taxes. Do I have to pay taxes on income that I earn in Illinois? Well, Illinois is actually pretty specific. They want you to pay taxes on income that you actually earn in Illinois as a non-resident. So I would have to pay income on the income portion. It would just be limited to the income that I earn from the partnership. That's what I'm going to pay taxes on, generally speaking. On the other hand, like what you have is it's different because you have a bank account. Bank accounts are different. I would say pretty much the same logic. Where's the bank? Is the bank in Illinois or is the bank in the other state? Just something to think about. Also, look at that particular state. I gave you like an oversimplified, explanation. It goes to wherever the state is, wherever the asset is in that particular state. But the question that you asked me, because it gets a bit more trickier, because let's think about bigger banks. That'll work for a smaller bank. If it's a smaller bank, local bank, yeah, that'll work. Then it's earned where the bank actually is. But what if it's a bigger bank? Let's say, I'm against big banks, but give me a big bank.
PNC.
Yes, yeah, that's a pretty big bank. So PNC, I don't have a bank account at PNC, but I used to have a PNC bank account before it was PNC. I'll tell you more on that later. But then, in that case, PNC's nationwide. Where is it income? I don't have the answer for that because the only thing that I could say is just each state is different. I would try to say wherever you open up the account, but even then, that's not even a good way to explain it. I can't really give you an answer on that one.
Yeah, I had to deal with this once, moving from Pennsylvania to Illinois. It was, I'm pretty sure I just got double taxed on something.
Well, even with that, actually, even with that, because there's some states that allow you to claim a credit for a tax that you pay to another state, but even then that gets limited. In Pennsylvania, I'm not sure. That's a very good question. I'm not sure what the correct answer would be. It's easier for like partnerships because yeah, it's wherever the partnership is. That's where you have to file taxes. If you have a job where you work in New York, you work in Indiana and Illinois, it's from wherever you work. And that makes sense. You have to file New York return and so forth, and or wherever you made the income. But it's harder for unearned income, I guess. It's That's a good point. I don't have the answer for that. The only thing I could say it varies by state. You know, I would say it's wherever it originated from. I can sort of follow that fruit of the tree doctrine in a way. Is where is the tree? I guess it would be the metaphor. Where does the tree reside? Is it in Illinois? But even within, that's not even a good metaphor to use. I guess with that being considering the circumstances, it would depend on the amount. If we're talking about a couple $100, it really doesn't make a difference. But if we're talking about a couple $1,000, then yeah, you should do more research and then see give your client the best answer. That's the best that I can tell you with that one. So yeah, I don't have the answer for that one.
All right. Thanks.
Yeah, believe it or not, I don't always have the answers, but I know where to look. So that's actually, I'm glad that you asked me that question that I don't know the answer to, because there's going to be times that you're not going to have the answer to, and what's going to be your response? It depends, or let me do some more research. Again, you should do research. You got all the tools, and we've equipped. You've been equipped with all the tools here, and how to do research, and you should be able to do it in practice as well. So I mean, I'm more than confident that you'll know how to find the answer, especially with that one. So do your own research with that one. Any other questions regarding on income tax stuff that may be on the exam?
The kitty tax won't be included, right?
No, the kitty tax will not be included. That's good to know. That's not going to be included. So again, the exam, I guess, dealing with, so you can have more of an idea. There's going to be that big problem, which has, again, very similar to this: what's gross income, what's not, dependent or not, what credits to use. Again, very similar to this. The only thing is, I don't want you to give me. You see how on top it says City of Springfield bonds note 1? Don't do this. Just put whatever's income, and then on the bottom, just put municipal bond income is excluded. You don't have to put it on top and then tell me on the bottom, see note 1. Just tell me on the bottom it's excluded. That type of explanation. That's what I want to see. Again, the same thing, like this is not deductible. Just tell me on the bottom. You don't have to say, put it on top here and then say what's 0 and then see note. No, just put it on the bottom. Just tell me why. Any other questions on regarding that? All right, so then that's a big problem. In terms of the short answer question, again, the legislative process would be a good question, fair question to ask. The judicial system, primary source of tax law. There's going to be a question where I'm asking you what's the correct filing status and which credit applies. Is the $500 credit or the $2,000 credit? I want you to explain it. Is the qualifying child or qualifying relative? Just explain that way. There's going to be one basic question where it's going to be basic facts, and this is going to prepare you for the big problem, where you're just going to figure out the person's adjusted gross income and taxable income. That's it. You don't have to figure out the tax liability. It's just going to be gross income, adjusted gross income, and taxable income. Pretty straightforward. How many questions do I have now? That should be it, right? Oh, and the vacation home problem, and that should be it for the midterm. And I'm very confident that you'll do well on the midterm. You just got to do your part and study. And like I said, I'm not going to cover any new stuff. So if you don't have any additional questions, I am not going to end class yet. I want to go over some financial statements. You guys like reading financial statements? All right. I heard somebody say, "What do you mean a little? You're an accountant. How you're supposed to love financial statements?" All right, this is actually relates to tax class, and it relates to something that I find interesting. It's patients. This is actually Harborside. It's a case that's currently in appellate court, and I'm going to go over the notes real quick. And this is 2018 financial statements. I don't think the 2019 financial statements are available yet. Again, this is a very famous case, very famous client. So the financial statements are pretty straightforward. You know, you may remember something like this in your accounting class. You know, I'm not going to go over how to read the financial statements and the report itself. By the way, this is a Canadian-based financial statement, so it's going to be slightly different. The statement of financial position, what do we call it here in the United States? It's not the statement of financial position, but it's the same thing. What do we call it here? What do you guys think? It's your financial position, but it's not called the statement of financial position. Anybody? I'll give you a hint. It's something that balances.
Net assets?
The balance sheet. Assets equals liabilities plus owner's equity. That's your statement of financial position. By the way, it wasn't a trick question. Well, by the way, the statement of financial position itself is listed in financial accounting concept number 5. It does have statement of financial position. That's covered in more detail in intermediate accounting 1. Statement of operations. I guess we do call it statement of operations. But what's another name for statement of operations?
Income statement.
It's pretty basic. Think about it. Income statement. Statement of changes in owner's equity. We call it the statement of changes in owner's equity too. But it's also a statement of retained earnings. Statement of cash flows. Guess what we call it here? This is not a trick question. Guess what we call it here? Statement of cash flows.
Cash flow statement.
Yeah, same thing. Notes of the financial statement, same thing here. These guys have quite a bit of notes. I'm not going to spend too much time on the auditor's report. It looks different in Canada than it does here. Balance sheet, you know, straightforward. Balance sheet has to balance, right? What I will, liabilities, what I want to direct your attention to is the income statement. Did I ever tell you that drug dealers, I'm sorry, I didn't say drug dealers, any individuals that are in the business of trafficking Schedule 1 and Schedule 2 controlled substances can only deduct cost of goods sold. Cannabis it's a Schedule 1 substance. Even if they change it to Schedule 2, it's still going to be cost of goods sold. So for tax purposes, this company can only deduct cost of goods sold. Doesn't seem very fair. Take a look at what their cost of goods sold is. You know, even if you look at both years, you know, you guys see that? Very, very low. And that's pretty common type of business. You know, and the cost of goods sold is pretty much, you know, most of the profit right there. You know, so the cost of goods sold is huge, especially for a manufacturing company. Now, this is what I want to direct your attention to. Unrealized gain from changes in fair value of biological assets. This is just specific to cannabis. Well, not specific to cannabis clients, but this is one of the, I guess you could say specific to cannabis clients. Specific to IFRS, International Financial Reporting Standards. So in this case, they're making an adjustment of fair value. What this is really doing, if you see it on the bottom of gross profit before unrealized gain, it's recognizing profit prematurely. I don't agree with that method, but it's recognizing income prematurely. So it sort of creates the illusion that gross profit is larger than what it is. But think about this for a second. If it's recognizing it early, next year's number is going to be off. The timing of it, I don't agree with it. But there should be a separate note that discusses, you know, the unrealized gain from fair market value and stuff like that. Operating expenses, I'm not gonna, you know, go over into much detail with that. That's not deductible. But here's where it stops for, you know, companies that are in this type of business. I don't want to go into the statement of cash flows. Nature of operations, pretty straightforward. The note that I want you to pay attention to. Biological assets, it talks about what I just described. The tax notes. Well, here talked about income taxes, but that's not the one that I want you to you know. There's an actual note on the actual lawsuit. Actually, it's towards the end. Uh, here, here it is. Here it is. Now, in term this note itself, it's a pretty long note. Income taxes. You do got to, in a separate note, it does talk about that the only thing they can deduct is the cost of goods sold. But this is the note that pertains to the lawsuit. So I'm actually curious as to what's the updated note. The updated note should actually be probably in appellate court. So it has three pending U.S. tax court cases. Again, tax court ruled against them. It's actually in appellate court right now. So each of these cases has the same legal application, the application of Section 280E. Again, right here it tells you that what it does, because it's a controlled substance, they can only deduct cost of goods sold. So they're arguing over that. This has to be disclosed because they issued already a statutory notice of deficiency. It already went through the audit process. This is how much they owe. So that has to be, disclosed. So that's what it talks about. The deficiency notice, the IRS has asserted that the company is liable for tax deficiency. Well, you're stated, and it also talks about penalties. That's that 20% penalty that we talk about. Again, I also did talk about one of the courts already ruled it. The U.S. Tax Court ruled that Section 280 applies to any businesses which consist of trafficking in controlled substances, and they can only deduct the cost of goods sold. So it gives you more information, again, on the actual lawsuit. So here's where the assessment is 11 to 13 million dollars. That doesn't include, interest. So it's giving more information. Because this is a pending case, this has to be disclosed to the users of the financial statements. And that would be true with any type of lawsuit. That has to be disclosed in the financial statements. But because this is actually specific to the cannabis industry, it has information on, on this particular case. Again, this is the Harborside case. I also have the financial statement for Green Thumb Industry, GTI, if you want to take a look at it. A lot of these are, they're all in international financial, they're all IFRS financial statements. So, take a look at it. I'm not going to test you on financial statements. I just want you to have an idea what they are. For those of you who are going to pursue your accounting degree or even in finance in more detail, you will have to learn how to read financial statements or not learn more. You have to be excited about reading financial statements, or at least know how to, translate these financial statements to a language that we can all, understand. All right. So again, that's already on Brightspace. Take a look at them. I'm not going to test you on it, but just, for your own knowledge. Any questions on the financial statements? No questions? At all? Okay.
Do you think that the U.S. will move towards international standards, or will they keep doing their own thing?
Well, the U.S. GAAP they already been moving towards U.S. Standards a lot. A lot of the standards have been in conversion to U.S. and to IFRS standards. A lot of the standards, revenue recognition, moved towards that. Yeah, I see it. For it to be completely IFRS, probably not. But it's getting close to IFRS. As close as it can get. What would be revenue recognition is one. Leases similar to IFRS standards now. There are some things like IFRS does not recognize last in first out. That's something that's specific to US. Well, not specific, but US. It's actually allowed here in US GAAP, and mostly because it's allowed for tax purposes. So for LIFO, that's one method. That's I don't see that part changing. What would be another method? Oh, completed construction accounting. The completed contract method is not allowed for international companies, but over here in the United States GAAP, we can use completed contract or percentage of completion. I like percentage of completion because that follows the earning process, and that's actually what's used in international financial reporting standards. But that's always been there. So a lot of the standards are close to international standards, but there's some that are moving closer to it. But in terms of full IFRS, I don't see that ever being the case. Then again, I could be wrong. It all depends. Right now, just look at it this way: unless it's a publicly traded company, I shouldn't say that. Unless it's a publicly traded company that, and most publicly traded companies do trade in countries that use IFRS, so they have to use the IFRS financial statement. But if it's a publicly traded company that's only trading in the United States, then they have to follow U.S. GAAP, generally speaking. But most publicly traded companies do have international presence, and then they would have to follow IFRS. For example, this is an example of one. Even though like the financial statements are stated in dollars, but it's because it has interest in Canada. This is a Canadian company. It's they have to follow IFRS. A lot of the cannabis customers that or cannabis clients, the bigger ones at least, use IFRS financial statements. Because I guess that's what publicly traded companies use anyway. Something to think about. So yeah, that's what I can think about financial statements in general. But that's we'll cover that in more detail in intermediate accounting for those of you who need to take that for 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 the hours. That's going to be in the fall, and that may be offered in the same format that we're having now. So it may be easier, convenient. I don't know yet. I can't make any promises, but I'm guessing it may be. Any other questions on financial statements, on any other stuff we talked about? Again, this is going to be your last opportunity to ask me questions. So ask me questions now, forever hold your peace.
Back to the itemized deductions.
Okay.
Is there any restrictions for the amount of money you donate to charity? Like, let's say if it might exceed,
Yeah.
your income.
Yes. We haven't covered that yet. You don't need to know that for the exam. There is a ceiling, but the ceiling is actually pretty high. So it's again at 60% of your adjusted gross income. That's your ceiling, but it actually gets more complicated than that. But there is a amount. So it used to be 50%. In essence, you would have to get the old rule about 50% of your adjusted gross income, and then the rest. What happens to the rest? So there is a maximum amount. Now, one question that I do get a lot, when I'm going over itemized deduction, and I hope that this is not what you were trying to ask. The question that comes to mind is how much can I put? What do you mean how much can? And this is a conversation that I have with clients. I mean, what do you mean how much can you put? How much did you donate? Well, how much can you put? How much did you donate? What's the most I can put? You know what type of conversation I'm having, right? Or the client is trying to have with me. The client is trying to suggest for me to come up with a number so that they can put on the tax return. That is not our responsibility. They have to give the number to us. Now, again, as I mentioned before, use your judgment on what you're going to ask for documentation. In terms of what's the maximum allowed, it's 60% of your adjusted gross income. But when somebody tells you what's the most I can put, that's not don't answer that question. Just say, well, don't tell them the most you can put is 60% of your adjusted gross income, or whatever the ceiling is amount for that given year, because that can change. And never answer your question that way. Just tell them, well, the most you can put is whatever you can substantiate. That's the best way that you can answer. Well, how much can you prove? Type of answer. That's the answer that I want you to give your clients, because then you're gonna, if you start creating numbers, there's really no safe number, for you to tell a client, well, you can put this and you're not going to get audited. There's no such list exists. There are some people that believe that a list exists. There's no list that exists like that, because any number that you can put on a tax return, it can get audited. And it can be $500, it can be $2,000, it could be $100. It depends. It's whatever the auditor wants to audit. But the most you can put, you can deduct is about 60% of your adjusted gross income. The excess gets carried forward for up to 5 years. So it's I guess the best way to answer that, if a client asks you, just tell them how much can you substantiate. What do you have record of, and just leave it at that. That would be the best way to answer that question. It at least helps you sleep at night. If you start putting items that they don't have any proof for, you can get yourself in trouble. You can get a reputation of being one of those tax return preparers that make up numbers, and you don't want to be that in that position. So, does that answer your question?
Yes, it does. I was just wondering because a lot of people like they create non for profits and then they don't. I don't know. It's just I guess it's a more complex subject. I don't know.
Well, hold that thought, and then we'll cover itemized deductions next week, and that's when we'll cover more on charity, but it's just there is a limit, and if you are very involved with that, but keep in mind that the value of your services have never been deductible. Just keep that in mind. You can deduct donations, you donate to clothes, and there's a lot of people that even they're close to the ceiling. So we'll talk about that in more detail, when we cover itemized deduction. But the ceiling is pretty, think about it. It's a little bit more than half you can give to charity, which is very generous. Now think about that for a second. Do you see most people giving 50% of their income to charity? Probably not. So very few people are even going to get into that level. So, but it's good to know. It's good to know what that ceiling is. But in the context of a client asking you how much to put, never answer that question. Always throw it back at them. Well, how much can you substantiate? Throw it back at them in that way, and that at least puts them on the spot. Yeah. Any other questions on itemized deductions or anything else? Again, this will be the last time you can ask me before the midterm next week. No questions about anything else?
I got one. I got a little one. I can't find it in my notes, but for qualifying nonprofit charities, it's a 501c.
What about it?
I'm just confirming it's a 501c.
Well, 501c3.
C3. Thank you. 501c3.
Well,
Thanks.
let's. I'm going to show you the different 501c. 501c3. That's it's if it's that type of organization, it qualifies. Other types of organizations, it depends. I'm gonna put up the code real quick so you can see the other sections.
I think C4 as well, but not 7.
What's that?
I said I think C4 as well, but not C7.
Well, we're gonna go over the list right now. I won't see. All right, here's the list. Here is the list. Come on. Why is it taking forever? What the heck happened? Uh, 501c. No, C. So you said 4. What is 4? Come on. So here's the 501c organizations. So again, religious, charity, scientific, that's C3. You said C4? Well, no, C4 would not count. Wait, what do we count? Actually, wait. Civic leagues organizations not organized for profits, but operate exclusively for promotion of social welfare. I guess it could work. Labor unions will not work. 5 would not work. 6 would not work. And we talked about this one, before. That's the professional CPA society would be 6. NFL, would be, donations made to the NFL would be in that category. So I guess, yes, C3. Yeah, C3. 4 may work, but the other ones, no, it wouldn't qualify. 8 will not work. Fraternal Beneficiary Society, or, Orders Association, that will not work. Yeah, the only one that will work is C3. C3 would work. Again, here's a list of organizations. It's pretty straightforward. Want to read the history? It tells you the history. 4 may work, but yeah, it's only C3 definitely works. C4 may work. They'll read the letter. The letter tells them what type of organization it is, but C3 will work. 501c3 will work. C4 perhaps, depending on the circumstance. All other entities probably not. Again, unless it's set up as a qualified foundation. Any other questions?
Yes, for the head of household, will a person, like, let's say this scenario, like a person that is not married and he has a qualifying depend, like, let's say his roommate doesn't work the whole year, lives with him for the whole year, can he be a head of household?
No.
No, it has to be relative.
Yes, a person has to be related to you. Remember, you can't get a head of household for claiming your significant other that lives with you, or your friend that lives with you, or your cousin that lives with you. That person has to be related to you to claim head of household. You can get single, and you can possibly get that $500 credit, but not head of household. Again, the key word is that person has to be related to you, and it has to live in your household.
Oh, okay. Unless it's the parents, they don't have to live with you, right?
Right. Exactly. The parents do not have to live with you so long as you're paying for their household expenses. Correct.
Okay, thank you.
Yeah, thank you. Okay. Any other questions? No other questions? Are you guys going to be ready for the midterm next week?
Yes.
Yes. Everybody's supposed to say yes.
Yep.
Let's try this again. Are you guys going to be ready?
Yes.
Okay, that's better. So again, use this time to study. The midterm is going to be available on the whole day on Monday. Again, 3 hours to complete the exam. Create your own spreadsheet. I think everybody, it seems pretty straightforward on how to use it in Brightspace. You're not going to see your answer right or your score right away. I'm going to do my best to grade them before the next session, or at least by Wednesday. That's my goal, to have everything graded by Wednesday. So we are going to resume class next Wednesday. Remember, Monday is going to be your midterm. Next Wednesday is going to be when we resume class. So when we resume class, we're going to continue where we left off. We're going to be net operating losses and business losses. We're not going to skip a beat. So we're going to go straight to the information that we went over, that we started to go over today. So keep that in mind. If we don't have any questions, and need somebody to make a motion to adjourn.
Motion to adjourn.
Second. All right. I'll see you guys next week. Good luck on your exams. Enjoy studying tax.
Thank you.
Okay.
Thank
Thank
you.
you. See you guys.
Bye.